Just a standard risk disclosure before today's video. I'm not a financial advisor or trading expert. I'm simply a trader that likes sharing a bit of what I know. Trade at your own risk. I hope you enjoyed the series. Hey, welcome back to my third video in a series I'm calling Back to the Basics, where we'll work on covering all the basic fundamentals needed to start trading futures. From beginning to end, I want these videos to be straight and to the point, focusing on all areas of knowledge needed to start taking trades and build that confidence within yourselves. In the last video, we specifically talked about candlesticks, what they are, we saw how they printed, we understand the characteristics. Now today, I want to focus on how we implement that in reading a chart. So when you pull up a 2000 tick chart for the E-mini S&P 500 futures market, we've got time down here at the bottom that's continuing to move along, and then we've got prices on the y-axis here. Now, the way futures contracts move in the market is very different from how, let's say, stocks move in the market. Stocks will move in dollar amounts, whereas future contracts will move in ticks. And those ticks are associated with dollar values in the market. Now, 4 ticks in the E-mini S&P 500 futures market is equivalent to 1 point. So get a little note here. 4 ticks is equivalent to 1 point in the market. And now 1 point is equal to 50 US dollars, and that's utilizing one contract. So as prices move down and move up in the market, they are moving in tick values, and the market will rise and fall a certain number of points. So if you can catch moves in the market, whether they're going up or they're going down, 1 point is equivalent to $50. So if you're trading one contract and the market moves 1 point in your favored direction, then you've made $50. If you're trading two contracts and the market moves 1 point in your desired direction, you've made $100. Now, on the other hand, if you enter the market and the market goes against your desired direction 1 point and you're trading one contract, you've now lost $50. If you're trading two contracts, the market does not go in your favor, it goes against you, you've now lost $100. Now, when we talk about direction of the market, markets can either move in bullish directions or they can move in bearish directions. A bullish direction means prices are continuing to go up. Bearish direction means that prices are continuing to go down. Now, in a futures market, you can make money trading either direction. You can either place buy orders if the market's going up and you want to capitalize on that move, but then you can also short the market, which means you can make money if prices are going down in a bearish direction. So pulling up the paint here, let's try and draw some pictures, make it easier. Let's talk about buying first. And I want to try and make this as simple as possible. So let's just pretend that we're not talking about the stock market today. Let's say we're talking about a cookie market. And I want to make money in this cookie market. Now, standard stocks, for example, or let's talk about the cookie market. The way you make money in the market, if you're trying to buy into the market, is you're planning to buy an object, buy a commodity, buy a stock, buy a future at a certain price level. So we got this cookie, right? And this cookie is worth $5 when we buy it. Now, over time, this cookie increases in value. And now, based on the market, this cookie is now worth $7. And I choose to sell the cookie now, and now I've made a $2 profit, right? Pretty simple, straightforward. This is how we tend to understand the market. We understand stocks. You buy a stock at a low level, you sell it at a high level, you make some money off of it. Okay, so now let's talk about selling or shorting. Initially, we're talking about buying. I actually should have put, so if we're going long on a position, that means we anticipate prices to go up. We're going long into the position, we make money off of it. For selling and shorting, we're anticipating prices are going to go down. Now, what does this mean? Let's continue this cookie analogy. Let's say we've got this $7 cookie in this cookie market, and we anticipate this cookie is going to go down in price. What we as traders can do, take a borrowed cookie and sell it for $7. Right? So we have this borrowed cookie. Now prices fall to a certain level, right? Let's just say they go back to $5. Now we have to return this borrowed cookie, right? We have this borrowed cookie, it's worth $7. Now it goes back to $5, right? But the initial value of that cookie we had was $7. So when we return this cookie back to the market for $5, we had the cookie valued at more. And so when we give this $7 cookie back to the market that has it now valued at $5, we get the difference there. We get a return of positive $2. We had bet that the cookie market, was going to go down. So the idea of shorting can be a little bit complex versus going long on trades. So if you don't fully understand the concept, that's completely okay. Just know if you're shorting the market, you're betting that prices are going to continue down. And if you're going long on the market, if you have a long bias, you're anticipating prices are going to go up. Now, instead of talking about cookies, we're talking about futures contracts. So if you buy a futures contract at this level and it goes up and then you sell it at a higher level, you've now made money. You've made the difference of movement that price has made. If you're shorting the future, that means you are selling you're selling the cookie up here and you're buying back in to the market down here. So you're taking a borrowed contract, you're selling it for a set price, and as prices come down, you're buying back into the market and capitalizing on the difference that was made here. Going long versus going short are just inverses of one another. They're opposites. So now let's say you buy a futures contract all the way up here, anticipating they're going to push higher, and instead they go lower. You buy this contract, and as it goes lower, you're losing value on that contract. You're losing money because now that contract is worth less than where you bought it at. Now, let's say you're trying to short a contract down here and prices continue to push up. Well, we were just betting the market was going to go down. So now we're holding on to a contract that's worth less. And as prices continue to move up, we still have this less valued contract. And as prices continue to move up, you'd be losing money holding on to that short contract. But again, don't let it confuse you too much. If market's going up, it's bullish. If it's going down, it's bearish. We can either buy and go long into a market to make money, or we can sell and go short to make money. It doesn't matter the direction. Now, the tricky part, of course, is being able to ask ourselves, well, when is the market going to start going long? When is it going to start going short? We saw how bars print. And so as we go bar by bar here, you can see prices continue to go up. But it's a matter of how do we know it's going to go up? And we'll talk about that in later videos. But for just a second, let's get a ruler out here so you can see exactly the type of profit that you can make if you catch moves like this. So let's just say you have a market order, you buy in to the market here. As prices continue to push up, if you're trading one contract and prices move, let's just say 8 points off one contract, that's $400 if you manage to catch this move. And then fast forward inversely, if you enter the market on a short order, as prices continue to fall, depending on how low they go here, let's just say 8 points, you could be making $400 if you capitalize on this move. Now, there are strategies that we try to implement that help us try and capitalize on these moves of the market. Now, we're not necessarily always going for 8 points, 5 points, 4 points. Usually we're capitalizing on 2 points, let's just say, in the market. We're looking for the market to move 2 points in our favored direction. Now, there are people that only go for 1 point in the market. That means you're only looking for a move literally this big here, and we can move this little box anywhere. All we need to do is fill that little box, 1 point, and one contract will equal $50 in the market. But on the other hand, let's say we want to try and fill this box. We think that prices are going to continue moving up. So we have an order, we place it, we enter the market. We're just looking to fill the box so we can make $50 off one contract. If prices do not fill that box and they don't go exactly where we want them to go, we will lose money. And as prices reverse, we could be losing a lot of money. So now rather than, oh, I almost made $50, if you don't get out of this market and prices continue to move down, you've now lost upwards of $212. And if prices really continue moving down, you've lost $300, $400, all the way down $500, $600 off of one contract. Now that's obviously a lot of money. And this is just trading one contract. So if you're trading multiple contracts and you don't have safety measures in place to protect yourself from big losses, you could be losing a lot of money. And that's why risk management is really important. When we enter our trades, we want to have a price target of where we anticipate prices are going to go. And if they don't move in our desired direction, we have to have a stop loss in place. We have to have an order that gets us out of the market. So instead of losing $600, we're only losing $100 or $150. Now, even that can sound like a lot of money. But if you're going for 2 points, let's just say, well, now that $50 on one contract becomes $100 on one contract. So you could also be making a lot of money. But again, there are strategies in place and methods that we can use based on price action to protect us from taking trades that could really hurt us. It really is about managing risk, it's about staying consistent and maximizing our wins while minimizing our losses. So, those are going to be the basics today on reading a trading chart. We talked about buying versus selling a market. We've talked a little bit about how futures move in ticks and points versus dollar amounts. And we've introduced a little bit how lucrative, but then also how risky trading futures contracts can be. If you like this video, please leave a like, subscribe to the channel, turn on post notifications so you know exactly when I post this content, and leave a comment down below. Let me know if you're enjoying this series. Let me know if this is helpful for you as a beginner. Is there anything that you're truly confused about? Is there something that I could be explaining better? Let me know down in the comments below, and don't be afraid to check out other YouTube videos that talk specifically on going long versus going short. I really just wanted to introduce the concept for the purpose of this series so that we can move forward and continue learning about other things. I appreciate you for watching, and I'll see you in the next one.